All right. Well, welcome back to the iWealth podcast. We just finished quarter one of 2022.
Yeah, already.
Exactly. And kind of give us the big picture walkthrough. What's all happening right now?
Yeah, it certainly has been interesting, right? If you had the news on, I'm trying to stay away from it, but you still catch it, obviously. But with what's going on with Russia, inflation, and all the other things that are happening, it's been an interesting quarter, to say the least, Matt. The S&P actually was down about 4%. And here's what's interesting about it. When you look at when Russia invaded Ukraine, which is horrible, but we had our state of the markets that we put on that you were at. And we talked about how these geopolitical risks are really short-lived from a stock market standpoint. Mm-hmm. Anyway, we've made back that already. So we went down initially when they invaded. We're already made back what we lost in the market temporarily during that time period. So, but you watch the news and you wouldn't think
you
that
wouldn't
we're
guess
back.
that.
No. But anyway, so S&P was off about 4.5%. Bonds were down almost 7%. So U.S. government bonds, the Barclays Aggregate Bond Index, was down about 6.8 for the quarter. So you're in safe bonds, which you would think would protect you more than the risky stock market, which is the S&P 500, and bonds were actually down more. And that just kind of gets back into inflation. I mean, if you've been to the store lately or got filled up with gas, you understand what inflation is. We're all feeling it. Inflation, they kept on saying last year when you kind of looked at the Fed notes or listened to the Feds, they kept on talking about the standpoint that we're in this time period where inflation is going to be temporary. Mm-hmm. And they coined this term around that temporary inflation. Well, now we're finding out it's not temporary.
It's here to stay.
Yeah, it is. And so it's going to be here a little bit longer. We do think things will kind of settle down towards the end of the year. But when you take a look at oil being over $100 a barrel and groceries and things like that, it's going to be here for a while. You have many more people wanting jobs than there are jobs to have. So there's really no unemployment out there, which means that employers are going to have to pay more to have somebody come in and work for them.
Yep.
So you're going to have some inflation issues that are going to be here for a little bit longer. Bottom line, we think at the end of the year that this thing straightens out, meaning the S&P 500. We were down over 10, now we're down 4. We think that that's back into positive territory. And when we say we just use the people that we follow, the economists, and try to gather information from them.
A collective of all of the different minds that are out there.
Exactly. I don't have some widgets in Wasika where I sit down and try to figure it out. We're just trying to use the brightest minds we think. But anyway, we think that it will. But volatility is here to stay. Okay. A 10% pullback has already happened. It could happen again. The average is 13% over the last 20 plus years that we have a 13% pullback in the market. We didn't have hardly any last year. So this volatility is going to be here, which means there's opportunities to buy as well over that time period.
Very cool. So is that kind of the big picture update, or is there anything else that's happening now in Q1?
Yeah, so I would just say, when we start to have this volatility like this, we're having a lot more discussions in the office with JP and Sean and myself with clients around risk, and we have some tools that help assess risk. And it's just really important that if you're going to need money in the next 12 to 24 months, that you have that money somewhat protected. There's different time periods when you would draw from different buckets of money based upon risk. So if your risk score is 0 to 10 and all your money's invested at an 8 and the market's down and you're down 5%, you don't want to be selling those. You need to have different buckets of money aligned for that risk. Mm-hmm. So all I say to people is that if you're like yourself and you've got 15 years of retirement, this is just a blip and we'll get through this and buy on the dips. But if we're in a spot where you're going to be drawing from your money or needing some of those monies, then I think it's really important that you have that.
Which is mainly like a house purchase or a big car purchase, or if there's a second home property type of purchase.
For sure, or retirement income.
Income.
Yeah, if you're going to need $5,000 a month out of your investments, you better not have that all sit in the S&P 500 with the volatility. You need to have an investment management system kind of around that.
Sure.
So anyway, so talk to us, talk to your advisor, figure out that you don't have all your money in one basket, that it's diversified. And if the markets go down, you have a spot to take money from where you're not going to be hurt, because this volatility is here to stay. But we think it's going to be positive at the end of the year. Recession somewheres, it's always going to happen, but we just don't think it's this year.
Interesting. Well, very cool. And we'll see you back here next time on the iWealth podcast.
All right. Thank you.